Let's discuss it all. Tobias Levkovich joins us now, Citi's chief U.S. equity strategist. He's out with his 2021 year-end targets, predicts the S&P will see 3,800 and 34,200 on the Dow. Tobias, thanks for joining us. Great to see you as always. I mean, interestingly, assessing those two targets by percentage upside suggests more upside in the Dow. So I guess you're saying there a bit more room to run with the current rotation into cyclicals based on the makeup of those two indices.
Correct. Good to see you as well, Wolf. So look, we think that in general, the market is in somewhat better shape because of some of the news we're getting, particularly around vaccines and things like that. It's not all going to come together, in the very, very short term, but market tends to be a little bit more predictive of the future. And more importantly, more modest upside, because if you start losing some of the leadership from the very, very large mega cap, $1 trillion type tech companies, that will act as a bit of a hindrance for the broad S&P. And as a result, that rotation probably continues, but they're going to get, some bumps along the road. It's not all going to be perfect. And I think the real turning point might be around February, March, April next year, when you start seeing some of the, what you would call work from home, shelter in place, COVID beneficiaries start to comp against some really difficult numbers the prior year, being 2020. And the COVID impaired industries actually see a much better improvement in their trend in terms of at least the perception for several months of really, low base effects generating what seems to be much more powerful business momentum.
And so, Tobias, where do you see, let's say, the 10-year by December next year? And how is that influencing what you think a sort of reasonable valuation multiple is and which sectors will outperform? Sure.
So our fixed income strategist, a gentleman named Shabazz Mathai, who makes the rate call for us, I don't do that, is looking at 1.25 on the 10-year yield by the early part of next year, probably the end of 2021. Now, part of this is, again, as the economy is getting some better strength, partially because of vaccines, but also if you look at something that probably got overlooked the last couple of weeks, was the senior loan officer survey from the Federal Reserve Board showing an improvement in credit conditions and easing in the tightening. We'd seen some severe tightening, almost reminiscent of what we saw in 2008, 2009. And it has started to ease up. That's usually a really good 9-month lead indicator for cyclical economic activity. So from that perspective, we should get, again, improving trends looking into next year, particularly second half.
Shepard Smith here. Thanks for watching CNBC on YouTube.